Well, first of all, thanks to all the panellists for some very interesting and, in fact, quite enlightening presentations. The way I'd like to run the rest of the session, we've got about 15 minutes left. I'd like to provide the panellists with an opportunity first to comment on what they've heard from other panellists. If they've got a remark they'd like to make, I'll give them that opportunity. Then I'll open it up to the floor. But seeing I've got the microphone at the moment, there are a couple of reflections I wanted to make, and I'm pleased David Walker is not here today, because both of the reflections are going to relate to David Walker, and he'd be a little bit embarrassed if he were here. They're positive things about David Walker, I should say. Paul mentioned that the United States government had a qualified audit opinion. Now that's very, very rare, Paul, that I would ever question anything you say, but the truth of the matter is that the United Kingdom has a qualified audit opinion in its financial statements. The United States technically does not have a qualified audit opinion, and it was David Walker that took the action that I'm about to describe. Now, this is a technical distinction that an accountant or an auditor might regard as important. Regulators certainly regard it as extremely important. David Walker, when he was Auditor General of the United States, issued what is technically known as a disclaimer. He didn't issue a qualified audit opinion, he issued a disclaimer. A disclaimer says, I'm not going to express an opinion on these financial statements. The information is insufficiently reliable for me to express any opinion. Never mind a qualified one, I cannot express an opinion. So it was a disclaimer. What that triggered was the thought that, in relation to what Vincent was saying, if governments won't give rating agencies the information, what about a disclaimer? We won't issue a credit rating unless you give us the information you want. Just maybe an item for discussion. The other point in relation to David Walker is at the time that in IFAC we were initiating the program for international public sector accounting standards, David Walker was then heavily involved in InterSci, and I don't know whether any of you are familiar with InterSci. It's a rather grandiose organisation. InterSci means the International Organisation of Supreme Audit Institutions, that is, government auditors. And at the time, InterSci set government accounting standards. And so what IFAC was trying to do was basically muscle in on the territory that InterSci was already in. And it was very interesting, as a key player in InterSci, David Walker urged them towards IPSAS and basically stopped InterSci setting public sector accounting standards and left it to IFAC. And the reason he did it comes to a point that Fergus made. He did it because the standards they set were the lowest common denominator. They would not set a standard that could not be met by every member of InterSci, which is effectively every government. And one of the problems that it seems to me that you would really want to see overcome in rating sovereigns is anything which constrains the rating opinion to information which can be supplied by every government, because that pushes you to the lowest common denominator. And it seems to me that's exactly what we shouldn't be doing. One of the dangers of making me moderator is that I will use this microphone. Okay, that's just a couple of thoughts about what I heard. So I said I'd give the panel an opportunity to make any comments or reflections they have on what they've heard from other panelists. So,
well, actually, I'm grateful, Ian, because I didn't have any comments for my panelists, but I wanted to comment on something you said, and that was regarding information availability. You have to remember how ratings actually started and what they do, and regulators don't. It's an arcane area. It's an arcane business. What you have is, it started as a result of rating railroads in the US, and John Moody started the whole industry, and he said, well, they're selling bonds, and they actually were realty bonds in the US, and he said, if they're selling them in the market, I'm going to use all available information that's in the market to every investor, and I will give a rating. And he said, by the way, railroad company, if you want to give me more information, that's okay. But if you don't give me information, I'm just going to base the rating on what's available. So in fact, rating agencies have followed that. Some regulators are demanding that if you don't have proper information, you stop a rating. Well, it's completely contrary to what has worked for 100 years plus. And so, if somebody is selling something into the capital markets, then a rating agency traditionally has rated based on the best available information. And it doesn't matter, so if somebody doesn't give you the information, well, my goodness, they're putting themselves at a lot of risk.
Thank you, Vincent. Okay. Any other comments from the panel? No? Nicola.
Yeah, I was fascinated by Paul's suggestion of the Kazarian, which happens to be on the screen right now. And one of those aspects here is audit quality. So the point I want to make is not exactly not a question, but an observation. I tried to look at this matter of audit quality in a comparative perspective, cross-border comparison for corporate accounting. And you would expect that there's more information, it's more sophisticated, and therefore it should be easier to do for corporate accounting than for government or public accounting. There is zero information. It's impossible to form an opinion as a researcher on cross-border comparisons of corporate accounting with the currently available data. I think it's a big collective failure of the corporate accounting community and system. It should be characterized as such because it hampers a lot of good things. The fact that we don't have that sort of comparative indicators for audit quality. We can discuss why this is the case, but it's an observation which I think is germane to what Paul presented.
Thank you, Nicola. Jacob.
Yeah, I mean, I'm really fascinated, Vincent, by your statements, which seem kind of historic to me. I've also studied Moody. One of the other things that Moody did was that he was selling independently that information to investors in a series of reports and booklets. He wasn't actually being hired by the companies to do this. I mean, many people have lost all confidence in the ratings agencies. I think the kind of openness that you guys both you all displayed today, we really need to see more of that. And I think that there are a lot of people in this room who agree. It also shows that the rating agencies could be doing a lot more. And the problem is how much for profit are you going to be? I like Moody's model. I don't see why it would work. You're just going to make possibly less money, but because it's not going to be a big industrial thing, it's actually going to be a report that's sold. So I don't know what you think about this model. I mean, you watch Michael Lewis, read Michael Lewis, the things he says about, the rating agencies are just utterly damning. That's what the public thinks like. And that's what, I'm sure there are people in this room who think that too. Members of government are just like, the rating agencies. So what do we do to make this better and more effective? We can't live without these independent things. Well, it doesn't matter what party you're in. You need to have evaluation somewhere. And we're in a crisis situation. So what do we do?
Well, you're quite right that until the 1970s, if my recollection is correct, Moody's only had subscriber fees. But no one worked for Moody's. I think all the people were like 15 people who sat on one floor. Once the bond markets and the real growth of the bond rating agencies in the US occurred as a result of the default of Penn Central on commercial paper. And what happened is after that, people really got interested in ratings for the first time. And some brilliant man at Moody's, I don't remember, I've heard his name, but I don't remember it, said, well, the only way we can have resources to do the ratings is we got to figure out another way to get fees. And so he came up with the having issuers pay the fees. And it worked quite effectively. No one's been able to make enough money to pay analysts. Moody's analysts, and I'm sure all the other rating agencies, are not paid like investment bankers, but they have to be paid rather well or they're not going to do it. So I don't see what other model you can come up with except try to reduce the potential conflicts of interest. However, I must tell you, though, and all my years, and I was 15 years with Moody's, not longer than that. Before that was with banks. My career has always been wherever the capital markets are moving, and banks fortunately got out of the sovereign area because they don't want to lend anymore, because they lost so much in the 80s. But when you have the capital markets, they just need this information, and you need to somehow figure out a way to pay for it. Can't figure out another model. No one has been able to. And you'll notice when the regulators really get involved and they get more knowledgeable, they actually step back a lot. And so a lot of people have perceptions about what rating agencies do. But again, Fergus was right. It is one of the crudest things. It is trying to conflate how much information into one single rating. Another aside, by the way, Moody's created the AAA, AA, single A, but he sold that to S&P. And then he created the other one, AA, 1, well, they didn't have 1, 2, and 3. They just had AAA, AA, et cetera. But anyway, I can go on and on about that stuff. But leave it.
Thanks, Vincent. Okay, do we have other thoughts or questions from Peter, Ian?
Yeah, just a little two factors. I believe that a significant influence on the risk of a given country defaulting its debt is whether it has done so in the past. I believe that a significant indicator, a risk indicator that a country might default on its debt in the future is whether it has done so in the past. There are countries out there who have never defaulted or almost never defaulted and are very unlikely to do so, and there are countries out there who have defaulted frequently in the past. And then my question to the credit raters is, how does that influence your figures? Where does that go? And then a second thought has just occurred to me, looking at the proposed sovereign index. It doesn't say, is this country part of a currency union or not? And I think that might have some influence on the situation.
Thanks, Peter. Any reaction to those?
So
Fergus?
I can give a stab at those too. In my opinion, if you get divorced once, you're more likely to get divorced again. In the case of Colombia, for example, during the debt crisis in the 1980s, 90s, Colombia was the one exception that did not default. And I think they weren't properly rewarded or assigned a higher rating as a result, partly because their debt was higher because they didn't restructure it. So it's a two-sided coin. But also I think the answer also has to do with the quality of the new government or the new regime and how permanent an improvement the policies are. And that's a far trickier a qualitative assessment than looking simply at how many times over the last 20 or 30 years a country has defaulted. Needless to say, a country like Argentina is penalized as a result of its serial default history. The second point you mentioned, the sovereign index, I forgot exactly your question on that one.
Whether you're in a currency union or not, whether you can issue your own currency.
Well, if you have an independent central bank in your own currency, clearly you have more flexibility. In the case of the euro area, or similarly for countries that have access to precautionary programs or full-fledged programs from the IMF or central bank swap lines, we do actually give weight to that support. And this is one of the reasons why DBRS ratings on Portugal confirmed yesterday, or France brought back to AAA stable yesterday, or Ireland, Italy, and Spain are a little bit higher than the other rating agencies during the crisis. One, we're trying to rate through the cycle, but more important, the benefit of support is absolutely significant. So in that regard, their membership of the euro area is important.
Thanks, Fergus. I've got 3 questions and we've got 4 minutes. So I'm going to ask people to be very quick and any responses also to be very quick. I've got Ian Carruthers, Professor Galbraith and George Seraphim.
Thanks, Ian. As I've recently taken over as chairman of the IPSAS board, obviously very pleased by the comments that have been made about IPSAS. I'm interested in this sort of push-pull type thing in terms of demand for IPSAS-based information. And obviously, I'm intrigued by the sovereign index. I wonder whether you think there's also just simply an awareness problem about IPSAS, or a sort of nuance to that. One of the things we've done recently is
put new governance arrangements in around our standard settlement process. To what extent is that an issue in terms of perception? So I'm just interested in that sort of things at the moment.
Okay, can we keep the...
Really quick.
Thanks.
The reality is that what you have to do is sell it to economists, because now almost all sovereign risk is handled by economists and all the sovereign stuff. So you have to show economists that it is valid and that it is not, so revolutionary they can't handle it. That's why I was trying to make that point, that in the rating agencies we had already did it, though we never really thought about it.
Thanks. Professor Galbraith.
Yeah, I just want to make a quick comment on the question of the future of the Eurozone. I had occasion during my time in working with the finance ministry in Greece to actually work on the problem of what would be required if Greece were forced out. And it was an extremely challenging and daunting prospect at the time. I think now, given the changes, countries operated for a year under capital controls, it would be, from a technical standpoint, far easier. Although the government has no will to do so and no capacity to develop that will, the material conditions have changed dramatically. You no longer have the kinds of issues of a cash shortage that would have been really very challenging in July of last year. I don't think it will happen in Greece, but I think if you take another country where the euro experience has been very adverse, but a country which has reserves and which is heavily banked and could easily move inside its banking system from one currency unit to another, you have a much more fragile prospect. I'd advise you to keep a distant eye, for example, on Finland as a possibility in that respect.
Might I just say one comment on that? We interpreted the fact that they moved the Greek government debt from Greek law to UK law, or foreign law in general, as one of the major hurdles that was created that would make it more difficult at the time for Greece to exit. If everything had still remained under Greek law, there would have been all the things you talked about, but there would have been much easier to handle as it was in Russia when they just used Russian law, and well, it is what it is. So that was an important point, that the Euro countries wanted to make sure they pulled it out of the Greek legal system, which I think was a mistake, but that's what happened.
Yeah. Thank you both. George.
Just a very short comment about credit rating agencies and what they're doing. I just want to read very, very fast a legal proceeding recently about Standard & Poor's, and then get a sense to what you consider to be the value of credit rating agencies. So there was a case about $5 billion in fines against Standard & Poor's, and Judge Carter, when he was denying the motion to dismiss, he wrote, Standard & Poor's repeatedly asserted that no reasonable investor would have relied on Standard & Poor's claims of independence and objectivity. Regarding the question of materiality, Standard & Poor's argued that since the issuer banks had access to the same information and models that Standard & Poor's analysts did, they could not have been fooled by faulty credit ratings. And the question is, this begs the question, if no investor believed in Standard & Poor's objectivity and every bank had access to the same information and models as Standard & Poor's, is Standard & Poor's asserting that as a matter of law, the company's credit rating service added absolutely zero material value as a predictor of creditworthiness? So this is the question of the judge, and the practical question for me is, since we have some members of the Greek parliament here and people are trying to kind of access and open the markets for the country, what is your advice about how those credit rating agencies could become of material value to capital markets, and what is your perspective about how do you go about educating the analysts and the markets, if you haven't?
Thank you. It's a great question. I do think, well, I'm very biased, obviously. I do think the credit rating agencies provide value. I think if this could have been quantified, it would have been done 100 years ago or 600 years ago. So there's a qualitative element. The reasons that we spend millions of dollars, pounds, euros, traveling around the world and meeting ministers and cabinet members is to try to get a sense of the thinking and the intention behind the policies. That takes psychology, it takes intuition, it's a human contact, and that's very, very important. I think it's very easy to get a credit assessment. 90% of a credit assessment right immediately. It's the other 10% that's extremely difficult to do. For example, in the case of Portugal, the minister himself 2 weeks ago in Washington convinced me of their intention to try to stick to the Stability and Growth Pact targets. That's very important. In the same way with Greece, I've had a little bit of difficulty getting in touch with public officials. That also influences the decision.
Thank you very much to our distinguished panelists.